Borrowers look like getting another monthly reprieve from rising interest rates when the Reserve Bank board meets tomorrow. Analysts say that the 6 rate hikes since last October have bought the RBA some time to observe the impact of the upheaval in Europe and weaker growth in the US. Philip Lasker reports.
Tomorrow's Reserve Bank board meeting takes place amid heightened global uncertainty. Europe is deeply conflicted by the need to slash debt and encourage growth, and the US recovery is beginning to disappoint. There's reason to fear America's jobless queues may not shrink as quickly as hoped. Markets are falling as analysts downgrade their earnings.
Corporations are also starting to come out with weaker guidance. We've seen this recently with companies like Dell, 3M, FedEx, Walgreen, Nike, all coming out with weaker guidance on their earnings.
But Australia is seen as marching to a different beat, although the services sector is still contracting with the index remaining below 50. Today we saw job ads rise 2.7% in June, while a private sector inflation measure saw inflation up 0.3% last month to 3.6% for the year, above the Reserve Bank's comfort zone.
Well, the numbers still say that the Australian economy is doing very well, and despite what we're seeing in Europe with respect to sovereign debt issues and also a slowdown, shall we say, in the US, the Australian economy is still doing very well.
But well enough to force a hike in interest rates at tomorrow's board meeting?
Inflation pressures, I think, are mounting. I think the central bank will eventually this year see a need to take the cash rate higher. But we're not there yet. I don't think we've yet seen enough information about prices for the RBA to move.
That may come by the August meeting, when the RBA will have the official unemployment and inflation numbers, both considered major indicators of the economy's strengths and the prospects for inflation, courtesy of a mining boom which is still expected to trump the impact of any bad news from Europe or the US.
We do have $75 billion worth of national income coming into the economy in the form of higher commodity prices. Now that's 9 times the size of the cash handouts by the Rudd government during the GFC.
The markets don't see it that way.
The market has in fact moved. If you think about market pricing, the market has actually moved to pricing in a 30% chance, around about a 30% chance of a rate cut by the end of this year. I don't think that's the right scenario. I think market pricing is very much reflecting the concerns, as you mentioned, in Europe and the United States, the risk, I guess, of financial instability accelerating in the global economy.
We are leveraged into those fast-growing Asian nations. We have very little economic exposure to the turmoil that's going on in Europe. Where we are exposed, of course, is in terms of financial markets and funding costs to our banks and our corporates. But the evidence to date is that banks and corporates are still getting funding. Yes, the funding spreads are higher than they were pre-GFC, but they're nowhere near as bad as they were post the Lehman collapse. So international investors are still happy to invest to Australia because, yes, they do see that we are different.
And the RBA will probably see it that way as well. Hence the expectation that there's only one way for interest rates to go, and that is up. Possibly as soon as August, but certainly before Christmas.